Welcome to this video, where we present a critical audit of Ghana's 2026 mid-year fiscal review. We will explore the transition from the IMF Extended Credit Facility to the Policy Coordination Instrument, focusing on macroeconomic alignment, debt sustainability, and key execution risks. While the government characterizes this period as a move from intensive care to a wellness center based on superior management, an objective audit shows that recovery is heavily anchored by debt restructuring and aggressive expenditure cuts, rather than structural revenue expansion. In terms of ECOWAS macroeconomic convergence, Ghana has successfully hit targets for the budget deficit, gross reserves, and central bank financing. However, the data reveals a significant failure to meet the target for average annual inflation. First quarter real GDP growth at 6.4% outperformed expectations, driven by real output rather than price inflation. The key challenge now is maintaining this momentum in the second half of the year, which is historically a period prone to fiscal slippage. The government is betting on administrative efficiency to offset revenue losses from tax cuts. However, with H1 2026 revenue missing targets, any execution delays in new technology-based tax collection systems pose a significant fiscal risk. Fiscal consolidation has been driven by expenditure compression, supported by the new commitment authorization rule to prevent off-budget liabilities. Operating at such a low expenditure to GDP ratio leaves little room for emergency social spending or unforeseen economic shocks. While the debt-to-GDP ratio has fallen to 45%, achieving this milestone so early came at a heavy cost to domestic balance sheets due to the debt exchange program. The challenge moving forward is sustaining this lower level of debt. The debt restructuring process resulted in missed IMF targets regarding central bank claims on the government. Recapitalization bonds issued to the Bank of Ghana represent a shift of the burden onto the central bank's capital, necessitating ongoing provisions from the budget. The GANRAP program marks a shift in external buffer strategy. By investing in domestic gold, Ghana is reducing exposure to currency shocks, though this strategy ties up substantial liquidity in commodity reserves. Transitioning to the IMF's Policy Coordination Instrument signals a move away from financial bailouts. This non-financing platform serves as a structural anchor to demonstrate long-term fiscal discipline to investors and credit rating agencies. A planned pivot in 2027 to lower the primary surplus will create fiscal space specifically for capital expenditure. If these infrastructure investments do not generate quick productivity gains, this policy could threaten the current 45% debt-to-GDP ceiling. While the central government's ledger appears stable, significant risks remain in the parastatals. Energy sector performance is a primary concern, and quarterly audit requirements for these entities highlight the vulnerability of the current fiscal framework. In summary, while the 2026 review shows a successfully stabilized economy, the margin for error is extremely thin. Sustaining this recovery without the safety net of IMF cash will require flawless execution and rigorous containment of state-owned enterprise liabilities.